I want to jump right into our first guest who's joining us. Tchir is the head of macro strategy at Academy Securities. Peter, happy to have you here on such an important day for markets. To me, the most important question remains, did the 10-year yield bottom out, and are we in store for reversal of bonds? What's going to determine that in your mind?
I think we are in the reversal for bonds. I think a lot of factors went into play in August. There weren't a lot of sellers around. There were buyers. There were a lot of passive flows. We've seen yields go higher, particularly at the long end. And I think the other factor that's at work is a lot of people have been buying stocks on one side and buying very long-dated bonds on the other. I think we're going to see that trade unwind a little bit, and that's going to put more pressure on long-dated bonds. Japan's trying to put some pressure on long-dated bonds. And ultimately, our own Treasury should be issuing fewer T-bills, more long-dated bonds. So I want to see back-end yield continue to go higher. I want to see the long bond at 250 and the 10-year closer to 2%.
So, Peter, we know that this uninversion of the yield curve we've had might be positive for some of the banks. It might be positive for some parts of the market. But one of the stories we've continued to cover here all year is that when this trade turns, if equity investors haven't rejiggered their own sort of portfolios based on the stuff they've been buying, the low vol, the bond proxies, how painful could this get if we indeed did see the low?
I think it will be reasonably painful. Right now, I'm kind of in this awkward situation where I'm bearish both stocks and bonds. Even this week, stocks are up less than 1% given the big rally on the week, and bond yields are much higher. So I think you're going to see that kind of continued pressure where stocks are going to struggle, partly because bond yields keep going higher.
So what does that mean in terms of positioning? I also brought up the idea that, look, it's not just the utilities and the REITs, it's the high valuation stuff. Doug Ramsey's up next, and he watches valuations like a hawk. And I know one of his points is going to be the market is still expensive. Does a bottom in bonds and higher yield potential take some of the air out for the TINA trade?
I think it does. And on top of that, I think assuming we get a trade deal, which feels like it's more and more priced in, everyone's just going to start thinking about what's the 2020 election look like. I think that's going to take some steam out of the stock market, right? There's not a lot of positives, I think, for stocks between now and the 2020 elections. But once we get through this, I think we're going to get a very classic sell the news, stocks go off, bond yields go higher, and that kind of works in tandem. Now,
all right, so Peter, that being said, though, right, it seems, again, the sensitivity of the bond market, to your point, looks like it is trying to find that, bottom in yield, high in price. But if something goes south here, I mean, is trade still the massive wild card? Can you really sort of make long-term projections until there's some, I guess, pacification of this dialogue that really heated up this week?
No, I think it really all comes down to trade. Trade is the single biggest thing out there. We need to find some closure on this. Again, I expect to see something that sounds like a truce or maybe a very light deal. I think it's too early, too far from the elections for the president to really want a big deal, but I think we get something that is calming. We're not going to get a great deal, and if we have talks break down, I would look for stocks to sell off very, very hard and treasuries to rally.
It almost kind of sounds like stocks are in this kind of catch-22, Peter. I know we've discussed this before, but if trade breaks down, then not good for equities overall and sentiment. And then if there is some kind of deal, it basically becomes kind of a sector and a stock-by-stock basis story, right, where you might have some important reversals that do hurt the equity trade a little bit.
Yeah, I think really since late spring, we were kind of betting on the Fed, right? So we kind of had stocks and bonds doing pretty well. I think now we need to see some reversal of that. If we get this trade talk, I think ultimately the Fed's going to step out of the way. They're not going to be as aggressive in terms of cutting. That's been a big supporter for stocks. So I think it's just a little bit of an unwind of what's been, this QE trade.
Yeah. The trick is right now you've got a VIX that's still around 17, Peter. I'm looking at it this morning. So it's not exactly the cheapest, put buying environment. It's not exactly the cheapest vol environment. It's not expensive as it was at 20. But how then does one go about positioning for this? Do you actually want to short stocks? I mean, that seems troublesome given the nature of how this trade deal could go. But at the same time, the alternative being what? Short bonds? Obviously, that's been a widowmaker over the past decade.
Yeah, I think you're supposed to be selling bonds. So, TLT continued, which is the 20-year plus ETF that tracks the 20-year treasuries. That's getting inflows. I'd be selling out of that. I'd maybe look at some puts on TLT. TBT is a inverse ETF. I don't like it because of how it's structured. But, yeah, I'd be kind of short, long-dated bonds or getting out of that exposure and bringing a little bit in cash. I think whether it's 2 weeks or a month, you're going to have much better entry points both for stocks and bonds. So pull some of your money out, keep it in cash. You're earning, some odd percent on the cash. and then you can reallocate once we've had a little bit of a dip.
Yeah. Peter, I want to talk a little bit more on the macro side too, as we are here. Does what works and what doesn't work for bonds work and not work for gold as well? Do you think about them as closely tied to each other? They've been a very high correlation trade for much of this year. Does that hold in this scenario?
Yeah, I think it's a little bit the case. I've actually watched Bitcoin a little bit more closely, I think, and when I've been watching Bitcoin, I think it's been a little bit of a leading indicator in what's coming out of China. And I think the fact that Bitcoin sold off a couple weeks ago ahead of kind of these latest rounds of talks was an indication to me that certain people in China think that there is going to be progress. Right? Bitcoin really led the way, looked much higher, and indicated that there were going to be problems back in February, March. I think we've seen the reverse of that a little bit. So I think you're going to see some complacency, some risk and fear taken out of the market. Brexit's talking about maybe being resolved. I think Europe's going to be still the big surprise of this fall, where they're going to put something on Brexit in the table. Lagarde is going to really switch that conversation to infrastructure spending. And I think we're going to actually start talking about global growth again rather than recession.
Yeah. Peter, I love it. Most people give me a crooked eye and think I'm nuts when I talk about BTC, but my point has been, look, not only is it your case here about the China flow story, which I think is a compelling one, but also the macro overlap that it's hard to deny Bitcoin has, at least through some of its investors, that see it as that gold alternative. So my question has been, if BTC breaks the way it has, is it, watch out below for gold? Is that kind of the next part to see how macro connections do really form between Bitcoin and the rest of the market? If gold breaks, is it kind of suggesting the look, we need to take this asset class a little bit seriously?
Yeah, I think gold should break down. I think, again, it's all going to be somewhat correlated, and I'm reasonably positive that we can pull out of this. I still don't think it's going to be great for equities just because of what's going to happen to the Treasury market. But yes, risk off, the fear about some global recession and political issues, I think is going away, and gold had too much of a bid and it's got to sell off.
Yeah. All right. Really good conversation, Peter. I like it. We got to run, though. We got to talk some stocks. Doug Ramsey up next. Peter Tchir, always a pleasure. He's the head of macro strategy at Academy Securities.